Ever feel like you're just drowning in information about investing? Like there's just so much out there,
Yeah,
you
no,
know?
absolutely.
You're not alone.
No.
So today, we're going to try to cut through all that noise
Mm.
and take a deep dive into quality investing
Okay.
using this book right here.
Right.
Think of it kind of like a cheat sheet to understanding what makes a business, truly great
Yeah.
and the kind that's worthy of your investment.
Yeah. We're going to be pulling excerpts from this book by Cunningham, Eide, and Hargreaves,
Okay.
and we're going to use some really fascinating case studies
Give 'em
to try to help you, the listener, discover how to like spot these companies with those like lucky genes
Uh-huh.
that seem to just consistently outperform the market.
And what's interesting is that these authors, they don't promise a quick path to riches.
Right.
Instead, they offer a framework for identifying truly like high quality businesses,
Yeah.
which I think is so key for making those smart long-term investment decisions. Exactly. It's like understanding the DNA of a company, right?
Yeah.
And they start by kind of breaking down the core building blocks of these quality companies.
Right.
One of the first things that they really emphasize is capital allocation,
Okay.
how a company uses its resources.
Yeah. And it's not just about spending wisely, right?
Right.
It's also about having the discipline to like avoid those bad investments.
Right.
The book actually uses H&M as a really great example.
Okay.
So during the 2008 downturn,
Yeah.
instead of scaling back, they actually sped up their store openings.
Wow.
They took advantage of those lower rents, right?
Yeah.
And the weaker competition. And that bold move, it really paid off for them.
That's a great example of how strategic decisions during tough times
Right.
can really be a game changer.
Yeah.
But it's not just about expansion, though, right?
No, not at all.
The book also talks about the importance of return on capital, or ROC.
Okay.
And it's not just about profit, right?
Yeah.
It's about how efficiently a company can generate that profit
Right.
from the capital that it's investing.
Imagine you have $1 to invest.
Okay.
Would you rather earn 10 cents on that dollar or 80 cents?
Right. 80.
High return on capital, it's like a company's financial fitness score.
I like that.
It tells you how well they're using their resources to generate those returns.
So how can we, like as investors, effectively evaluate a company's ROC? I mean, is there like a specific benchmark
Yeah.
or formula that we can use?
Absolutely. So ROC is calculated by dividing a company's net income
Okay.
by the total capital that it employs.
Okay.
Now, while a higher ROC is generally better,
Right.
what constitutes a quote-unquote good ROC can vary significantly by industry.
Makes sense.
For example, like a 15% ROC, that might be outstanding for like a capital-intensive manufacturing company.
Okay.
But it might be considered quite low for, say, like a software company,
Yeah.
with minimal physical assets.
Okay, so understanding the industry context is really important when you're looking at ROC.
Absolutely, yeah.
And what about comparing like ROC across different companies?
Yeah, good question.
I mean, are there red flags like that we should be looking for?
Definitely. Be cautious of companies with like consistently declining ROC.
Oh yeah.
This could indicate, a deterioration in their competitive position,
Right.
or maybe an inability to effectively reinvest profits to generate future growth.
Makes sense.
It's also important to consider trends in ROC over time.
Okay, yeah.
Is the company improving its efficiency,
Yeah.
or are they struggling to maintain profitability?
So it's not just a snapshot. It's about understanding the trajectory.
Exactly.
Got it. And the book also talks about the importance of diversified growth, right?
Yeah.
It's almost like cross-training for like a company's success.
Right, right. So the most resilient companies, they don't rely on just one product or one market. They create multiple avenues for growth, new products, expanding their customer base, venturing into new geographic areas.
So it's like having a diversified investment portfolio.
Exactly. You're spreading your risk,
Right.
and you're creating multiple opportunities for growth.
But wouldn't focusing on like a single core strength sometimes be like more efficient?
That's a great question.
Especially for like smaller companies with limited resources.
So focusing on a niche can certainly be a successful strategy,
Yeah.
particularly in those early stages of a company's development.
Okay.
However, as companies mature,
Yeah.
Over-reliance on a single product or customer or market can make them very vulnerable to disruption or economic downturns.
I mean, think about what happened to companies that were so heavily reliant on like DVD sales when streaming services just took off,
Totally.
Yeah, they were in trouble.
Big trouble.
So adaptability and diversification seem to be like really key for long-term success.
Yeah, absolutely.
Now, what about the role of management in all of this?
Okay.
Does a strong management team automatically equal a quality company?
Well, while a strong and disciplined management team can certainly supercharge a quality company, it's not the only factor.
Right.
Sometimes it's just about being in the right industry at the right time.
So even the best captain can't steer a sinking ship, right?
Exactly.
The book uses a really interesting analogy to kind of highlight this importance of industry structure.
Right.
They compare the soft drink industry with, Coke and Pepsi and aircraft manufacturing with Boeing and Airbus.
Okay.
Now, both are essentially duopolies, but the soft drink industry has been consistently more profitable.
Yeah.
Why is that?
That's a great question. It comes down to who holds the power in the relationship between the company and its customers.
Okay.
The soft drink industry, they sell to a massive customer base, right?
Right.
And this gives them significant pricing power.
Makes sense.
Aircraft manufacturers, on the other hand, they sell primarily to a handful of really powerful airlines, which limits their pricing flexibility and ultimately their profitability.
That's a great example of how understanding the dynamics of an industry is just so crucial.
Absolutely.
Even when you have really strong companies competing within it.
Yeah.
So we've got capital allocation, ROC, diversified growth, industry structure. What else should we be looking at when we're evaluating a company?
The authors also stress the importance of customer benefits.
Okay.
Both tangible and intangible.
Well,
So think about L'Oreal, the cosmetics giant.
Yeah.
They've really mastered the art of selling the hope in a jar.
Oh, I like that.
Right. They leverage these intangible benefits like the promise of younger looking skin to justify premium pricing for their products.
So they're not just selling a product. They're selling a feeling and aspiration.
Exactly.
That's powerful.
That's a very powerful marketing strategy.
What are some other examples of companies that that excel at leveraging these intangible customer benefits?
Well, think about companies like Apple and Tesla. They've built these incredibly strong brands that really evoke feelings of innovation, exclusivity, and status.
Right.
And so customers are willing to pay a premium for those products, not just for the functionality, but for those emotions and associations that come with owning them.
It's about creating a brand that resonates with customers on a deeper level beyond just the features and benefits of the product itself.
Right. And let's not forget about the assurance benefit.
Oh, right.
The peace of mind that you get from knowing that a product is reliable and backed by, a strong reputation.
Yeah.
Companies like SGS and Intertech, which provide testing and certification services, have built their entire business model around providing that assurance. Manufacturers are willing to pay a premium for those services because it instills confidence in their customers.
It's like having that seal of approval that says, this product meets the highest standards.
Right.
It's a valuable differentiator in a crowded marketplace.
Absolutely.
But aside from these intangible benefits, what about companies that offer more practical, tangible benefits?
So think about companies like Domino's Pizza or Dassault Systems, a software company that specializes in 3D design and engineering solutions. They've focused on making their products and services incredibly convenient and user-friendly.
Right.
And this convenience factor can be a really powerful driver of customer loyalty.
So it's about making things easier, more efficient, and more enjoyable for the customer. And that can create a significant competitive advantage.
Absolutely.
Speaking of competitive advantage, what are some of the key factors that that the book highlights in this area?
They break it down into 3 main categories: technology, network effects, and distribution advantages. So with technology, it's not just about, having a good product, but about the sustainability of that advantage.
The book uses Syngenta, the agricultural giant, as an example.
Okay, yeah.
They invest heavily in R&D to create innovative products that farmers just depend on.
Yeah.
Their success with a new fungicide to combat rust disease is a testament to that power of a strong technology advantage.
Absolutely. And then there's the power of network effects.
Right.
So the more users a platform has, the more valuable it becomes.
Right.
Making it very difficult for competitors to gain any traction.
It's like that old saying, the rich get richer.
Right. Exactly.
But in this case, it's the platforms with the most users get even more users.
Right.
What about distribution advantages?
Okay.
How can those contribute to a company's competitive edge?
So companies that control their distribution channels have a significant advantage.
Right.
The book mentions Luxottica, the eyewear giant, which owns retail chains like Sunglass Hut and LensCrafters.
Okay.
This gives them enormous control over their brand image and pricing, making it incredibly difficult for competitors to compete.
So it's not just about making a great product. It's about getting it into the hands of customers in a way that reinforces your brand and maximizes your profitability.
Exactly. Yeah.
That wraps up our kind of exploration of the building blocks of quality companies.
Yeah.
What are your key takeaways so far?
I think it's fascinating how many different factors really contribute to making a company truly high quality. It's not just about looking at their current profits. It's about understanding their capital allocation strategy, their return on capital, their approach to growth, the strength of their management team, the dynamics of their industry, how they create value for their customers, and how they leverage their competitive advantages.
A lot to consider.
It's a lot. But remember, we're looking for those companies that are built to last.
Right.
The ones that are really positioned to outperform the market over the long term.
Yeah. And we're just getting started.
Exactly. We're just getting started.
Right. Next, we're going to dive into some of those recurring patterns that often signal, long-term success for quality companies.
Great.
Stay tuned, because we're about to unlock even more secrets of successful investing.
I love it.
Okay, so we just uncovered the fundamental building blocks of what makes a company, high quality.
Yeah.
Now, let's shift gears a little bit.
Okay.
And explore some of the recurring patterns that often signal that long-term success.
Right.
It's like learning to read the signs, right? Knowing what to look for can give you a real edge as an investor.
Absolutely. And we're going to ground these patterns in real world examples.
Okay, great.
To make them, even more tangible and understandable.
I love that.
Yeah.
Because sometimes, these investing concepts can feel a bit abstract, right?
Yeah, for sure.
But seeing them play out in actual businesses just makes it all click,
Exactly.
So what's the first pattern on our list?
Let's start with recurring revenue.
Okay.
So think subscription services, maintenance contracts, or any business model where customers just keep coming back for more, right? Right. Generating these predictable and consistent income streams.
The gift that keeps on giving.
Exactly.
So it's like having a money tree that just keeps bearing fruit.
Yeah, I love it. The book gives the example of Keone, the elevator company.
Oh, right, yeah.
They generate most of their profit not from, selling the elevators themselves, but from those ongoing maintenance contracts that are just essential for safety and regulatory compliance.
It's a brilliant strategy.
It is.
They've turned a one-time purchase into a long-term revenue stream.
Exactly. And because elevator maintenance is non-discretionary, their income is much more stable, even during economic downturns, when new construction projects might decline.
So it's about creating that business model that just generates that reliable, predictable income.
Right.
Even when those economic winds shift,
Exactly.
That's a powerful advantage.
It is a powerful advantage.
What other patterns should we be on the lookout for?
Let's talk about friendly middlemen.
Okay, friendly middlemen.
So this is where Someone else chooses the product,
Okay.
but someone else pays the bill.
Okay, that sounds intriguing.
Right.
Can you give me like a real world example of this in action?
Sure, sure. Think about Geberit, the European leader in plumbing fixtures.
Okay.
So they've built these really strong relationships with plumbers
Okay.
by providing like free training
Mhm.
and emphasizing, product reliability.
Okay.
And this ensures that plumbers are just much more likely
Right.
to recommend and install those Geberit products,
Right.
even if, the homeowner might not even be familiar with the brand.
So they're essentially leveraging that plumber's expertise and influence to drive sales.
Yes.
It's like a built-in referral network, you know?
It is, yeah.
Why is this strategy so effective?
Well, it taps into that power of trust and expertise.
Okay.
So homeowners, they often rely on their plumber's recommendations.
Yeah, makes sense.
Especially for products that they don't interact with, directly.
Right.
So by cultivating those relationships,
Yeah.
companies like Geberit, they gain a significant advantage
Right.
in a market where, where brand recognition might not be as important
Right.
as professional endorsement.
It's a clever way to build that brand loyalty indirectly,
Yeah.
instead of like marketing directly to that end customer.
Mm-hmm.
They're focusing on influencing the people who are making those purchasing decisions.
Right, exactly.
What other types of businesses can benefit from this this friendly middleman approach?
I think it's particularly effective in industries where technical expertise or professional certification plays a really significant role.
Right. Okay.
So think about like medical devices,
Yeah.
pharmaceuticals,
Wow.
or even financial products, right?
Okay. Yeah.
By building those relationships with, with doctors, pharmacists, or financial advisors,
Right.
companies can gain access to this trusted network of influencers who
Yeah.
can, really shape those purchasing decisions.
So it's about understanding that decision-making process
Mm-hmm.
within a particular market
Yeah.
and identifying those key influencers
Yeah.
who can help drive sales.
Exactly.
That's a valuable insight. Okay, so moving on.
Right.
What's the next pattern on our list?
Let's explore toll roads.
No roads. Okay.
These are companies that control essential parts of the value chain
Okay.
and can really extract a premium for their services.
Right. Okay.
So think credit rating agencies, testing and inspection companies,
Mhm.
or providers of these magic ingredients
Right.
that are essential, but they represent a very small portion
Okay.
of that overall cost.
It's like owning the bridge that
Yes.
everyone has to cross.
Exactly.
Right. You have a captive audience.
Yeah.
And a lot of pricing power.
Right. The book uses Carl Hansen,
Right. Yeah.
the company that provides those essential cultures
Mhm.
for yogurt and cheese production,
Right.
as an example.
Right. So the cost of their product is like minuscule
It is, yeah.
compared to the overall cost
Mhm.
of making yogurt.
Right.
But it's absolutely crucial, right?
Crucial, yeah.
For taste and texture.
Exactly. Without those cultures, you don't have yogurt.
Right.
And because switching to a cheaper alternative could ruin that final product,
Yeah.
they have significant pricing power.
It's a fascinating example of how a company can just create immense value by controlling a small
Yeah.
but essential piece of the puzzle.
Right.
What are some other like characteristics
Yeah.
of companies that operate as these toll roads?
So they often have high barriers to entry,
Go.
whether due to regulation,
Yeah.
technology, or specialized expertise.
Yeah.
This makes it very difficult for new competitors to emerge,
Right.
which further strengthens that pricing power.
Right.
And they typically operate in industries with stable demand,
Right.
which makes their revenue streams more predictable and less susceptible to economic fluctuations.
So they're like the gatekeepers of their respective industries.
Exactly.
Controlling that flow of goods or services.
Mhm.
It sounds like a pretty attractive business model
It is.
from an investor's perspective.
Yeah.
What's next on our list of patterns?
Okay, let's dive into low price plus. Okay, low price plus.
Now, you might think that simply undercutting the competition on price isn't really a sustainable strategy.
Right.
And you're right.
Yeah.
But companies that excel at low price plus combine low prices with other value-added features that protect them from being, from being easily replicated.
It's not just about being cheap. It's about offering something extra that makes you stand out. The book uses Ryanair, the low-cost airline, as an example.
Right, Ryanair. So Ryanair, they've built their success on this culture of relentless cost cutting, but they've also innovated in areas like shorter turnaround times and efficient airport operations.
Yep.
They've even challenged, traditional aspects of air travel, like charging for baggage and onboard services, which allows them to keep those fares incredibly low while maintaining profitability.
Yeah.
So it's about finding those creative ways to reduce costs without sacrificing the core value proposition, right?
Exactly.
What are some other examples of companies that have successfully implemented this low price plus strategy?
Well, think about companies like Costco and IKEA.
Okay.
They offer low prices on a wide range of products.
Right.
But they also provide a really unique shopping experience that draws customers in. So Costco's, membership model and their bulk buying options appeal to those, to those value-conscious shoppers.
Right.
While IKEA's focus on design and functionality and self-assembly creates this sense of engagement and affordability.
It's about creating that value proposition that really resonates with a specific customer segment. It's not just about being the cheapest.
Yeah.
It's about offering that combination of price and other desirable attributes that meet a particular need, right?
Exactly.
Okay. So we've got recurring revenue, friendly middlemen,
Yes.
toll roads, low price plus.
Mm-hmm.
What other patterns should we be looking for?
Let's talk about pricing power.
Okay.
And pricing power is very closely tied to the strength of a company's brand,
right,
or its ability to offer, those unique and highly valued products or services.
Like think Hermes.
Okay.
The luxury goods company.
Yeah.
I mean, they can charge a premium for their handbags,
right,
because of their heritage, their craftsmanship, and that carefully cultivated brand image.
It's true.
They've created this sense of exclusivity and desirability that just defies traditional pricing pressures.
It's a great example.
Right.
But pricing power isn't limited to just luxury goods. It can exist in any industry where a company offers something truly differentiated and valuable.
Right.
So think about companies like Apple or Google.
Okay.
Their strong brand reputations, those innovative products, and those dominant market positions give them, significant pricing leverage.
So it's about creating that product or service that customers just perceive as indispensable or highly desirable, giving you that ability to command that premium price.
Absolutely.
What are some other factors that can contribute to pricing power?
High switching costs can be a major factor. If it's difficult or expensive for customers to switch to a competitor,
right,
companies have more flexibility to adjust pricing.
Okay.
So think about software companies with those complex enterprise solutions.
Okay. Yeah.
Once a company has integrated that particular software into their operations.
Right.
Switching to a competitor can be very disruptive and costly.
Right.
Giving that software provider significant pricing power.
So it's about creating that situation where customers aren't essentially locked in,
right,
whether due to brand loyalty, convenience, or the complexity of switching to a competitor.
Exactly.
That's a powerful advantage.
It is a powerful advantage.
Okay, so we've covered recurring revenue, friendly middlemen, toll roads, low price plus, and pricing power. What other patterns do we need to add to our quality company checklist?
Brand strength is a big one.
Okay.
And I'm not just talking about name recognition here. It's about heritage, trust, consistency, and that all-important emotional connection with customers.
Diageo, the global spirits company, is a great example.
Right.
They own a portfolio of brands with like deep historical roots, like Guinness and Johnny Walker.
Right.
This gives them a competitive edge that's just incredibly hard to beat.
Absolutely, yeah.
They're not just selling drinks.
No.
They're selling a legacy, a story, an experience.
Right.
You know.
And those stories, they resonate with consumers on a much deeper level, creating this sense of loyalty that transcends price or fleeting trends.
It's about building a brand that stands for something, that evokes a feeling, that becomes part of like the cultural fabric.
Absolutely.
Makes you want to, pour yourself a glass of something special and savor the moment.
Exactly.
What other companies come to mind when you think about brand strength?
Companies like Nike, Disney,
Yeah.
and Coca-Cola have built like incredibly strong brands that evoke like powerful emotions and associations.
Yeah.
They've become like synonymous with excellence, innovation, and cultural relevance, transcending their products or services to become, global icons.
It's amazing how a brand can become so deeply ingrained.
It is,
in our collective consciousness.
Yeah.
What's next on our list of patterns?
Let's talk about innovation dominance.
Okay.
Those companies that consistently invest in R&D and bound new, valuable products to market. Companies like 3M, which is known for its relentless focus on innovation.
Right.
Come to mind.
Yeah.
They've created this culture where new product development is just deeply embedded in their DNA.
Absolutely.
Allowing them to stay ahead of the curve.
And maintain that leadership position in a wide range of industries.
It's about having this culture of curiosity and experimentation and a willingness to embrace those new ideas.
Yeah.
So companies that excel at innovation, they're constantly looking for ways to improve their existing products, expand into new markets, and disrupt themselves before someone else does.
They're not just reacting to changes in the market; they're actively shaping it.
Exactly. Yeah.
That's a powerful position to be in. What other patterns should we be aware of?
Forward integrators are another group to watch.
Okay.
These are companies that control their distribution channels,
right?
Whether through their own stores, franchising, or online platforms.
The book mentions Inditex, the parent company of Zara, as a great example of this.
Right.
They've achieved like global success. With their fast fashion model, leveraging their efficient supply chain and adapting to local tastes to bring those new designs to market quickly.
They've mastered the art of vertical integration, controlling everything from design and manufacturing to distribution and retail.
Right.
This gives them incredible control over their brand, their costs, and their speed to market, making them a formidable competitor in that fast-paced world of fashion.
It's a fascinating example of how controlling that entire value chain can be such a significant competitive advantage.
Absolutely.
What are some other examples of companies that have successfully implemented forward integration?
Well, think about companies like Apple, which controls its retail stores and online distribution channels.
Right.
Or Tesla, which is building out its own network of charging stations.
Right.
So by controlling, how those products are sold and delivered, they can ensure a consistent customer experience, reinforce their brand identity, and capture a larger share of the profits.
So it's about owning that customer relationship from start to finish.
Exactly. Yeah.
That makes sense. Okay, so we've got recurring revenue, friendly middlemen, toll roads, low price plus, pricing power, brand strength, innovation dominance, and forward integrators.
Mm-hmm.
What else do we need to consider?
Let's talk about market share gainers.
Okay, market share gainers, yeah.
So these are those companies that consistently take market share from their rivals.
Right.
Which often indicates a superior product or business model.
The book highlights Fielmann, the German optical retailer.
Okay.
They've achieved dominance in their market by offering like fashionable glasses at lower prices, optimizing their retail operations and building that strong brand reputation.
They focus on delivering value to their customers, streamlining their operations, and creating that shopping experience that sets them apart from the competition.
Right.
And those consistent market share gains, they suggest that their strategy is resonating with consumers.
So it's about consistently outperforming that competition, gaining ground over time, and demonstrating that your business model is just more effective than your rivals.
Right.
What are some other indicators that a company is a market share gainer?
Well, look for companies that are consistently growing their revenue and profits faster than their industry peers.
Right.
Pay attention to their customer acquisition costs.
Okay.
Are they becoming more efficient at attracting new customers?
Makes sense.
And watch for those signs of innovation and product development. Are they bringing new products and services to market that are resonating with customers?
It's about looking beyond those current numbers.
Yeah.
And assessing a company's like trajectory.
Exactly. Yeah.
Are they moving in the right direction? Are they gaining momentum?
Right.
Okay. What other patterns should we be aware of?
So global capabilities are increasingly important in today's interconnected world.
Yeah, for sure.
Right. It's one thing to be successful in your home market.
Right.
But it's another to successfully expand your business model internationally.
The book mentions Inditex again as an example of this, right? With their ability to adapt their fast fashion model to different cultures and markets around the world.
They've clearly cracked the code of global expansion.
Yeah.
They've demonstrated this ability to understand and adapt to local tastes, navigate different, regulatory environments, and build strong relationships with suppliers and partners around the world.
Yeah.
And that's a valuable skill set.
It is, yeah.
In today's globalized economy.
It's not just about exporting your existing products or services.
Right.
It's about understanding like the nuances of different markets, adapting your approach.
Right.
And building that global presence that leverages your core strengths.
Yeah, exactly.
What are some of the challenges companies face when they're trying to like expand globally?
Well, cultural differences, language barriers, regulatory hurdles, and logistical complexities.
Yeah, that makes sense.
Can all pose significant challenges.
Yeah, for sure.
So companies, they need to be adaptable, resourceful, and culturally sensitive to succeed on that global scale.
So it's not just about having a great product and service. It's about having the right mindset, the right infrastructure, and the right team to navigate the complexities of that global marketplace.
Exactly.
Okay, so we've covered a lot of ground here, right?
Yeah, we have.
Recurring revenue, friendly middlemen, toll roads, low price plus, pricing power, brand strength, innovation dominance, forward integrators, market share gainers, and global capabilities. What else should we consider?
One of the most crucial yet often overlooked patterns.
Okay.
Corporate culture.
Right, yeah. The book mentions Svenska Handelsbanken, the Swedish bank that has consistently outperformed its peers.
Yeah.
Thanks to its decentralized organizational structure, its emphasis on customer relationships, and its conservative risk management culture.
Yeah.
It's a powerful example of how a company's culture can be such a significant driver of long-term success.
It's about having that shared set of values, beliefs, and behaviors that guide decision making, foster collaboration, and create a sense of purpose and alignment within the organization.
Yeah.
So a strong, positive culture can attract and retain top talent, drive innovation.
Okay, so we've explored those building blocks and those recurring patterns that contribute to making a company high quality.
Yeah.
But even with all these insights, there are still potential pitfalls on the road to, investing success.
It's like navigating a winding road.
Okay.
You need to be aware of those curves ahead to to stay on track.
So what are some of the common pitfalls we need to be aware of?
Well, even the most, stable businesses can be affected by economic cycles.
Right.
It's important to distinguish between companies that are, inherently cyclical and those that are, affected by cycles, but have those underlying strengths that help them weather the storms.
So the difference between a speedboat and a cargo ship.
Exactly.
Right. The speedboat might be more agile in calm waters.
Yeah.
But the cargo ship can handle rough seas much better.
Right.
The book mentions Saipem, the oil field services company, as an example.
Okay.
Right.
So Saipem, they looked like a fantastic investment during a period of high oil prices.
Right.
But when the cycle turned and demand for their services declined, the company was hit hard.
Yeah.
And it highlights the importance of understanding the cyclicality of the underlying industry.
Yeah.
And not assuming that good times will last forever.
Right. So how can investors identify companies that are more resilient to those economic downturns?
Yeah.
What are some of the signs we should be looking for?
So look for companies with strong balance sheets, low debt levels, and a history of generating consistent cash flow.
Okay.
These companies they're better equipped to weather those economic storms and emerge, stronger on the other side.
Yeah.
Also consider the nature of their products or services. Are they, essential goods or services that people will continue to buy even during tough times?
Yeah.
Or are they, more discretionary items that are more susceptible to spending cuts?
So it's about looking beyond the current economic climate.
Yeah.
And assessing a company's ability to withstand future downturns.
Exactly.
What other pitfalls should we have on our radar?
So technological innovation, it can be both a blessing and a curse.
Right.
While it can create, incredible opportunities, it can also disrupt, entire industries, leaving once dominant companies in the dust.
And think about Nokia. Once a leader in the mobile phone market,
right.
They failed to adapt to the rise of smartphones and lost their leadership position.
Yeah, it's a classic example of how failing to innovate can be fatal in a rapidly changing world.
Yeah, for sure.
It's a reminder that even the most successful companies need to be, constantly evolving and adapting to stay ahead of the curve.
Stay ahead of the curve, yeah.
They need to invest in R&D, embrace new technology, and be willing to cannibalize their own products and services before someone else does.
Oof. Yeah, that's a tough one.
It is.
So how can investors assess a company's ability to adapt and innovate?
Yeah.
What are some of the key indicators we should be looking for?
So look for companies with a strong track record of innovation.
Oh.
Do they have a culture that encourages, experimentation and risk taking?
Right. Yeah.
Are they investing in research and development?
Yeah.
Are they partnering with universities or startups to access cutting edge technologies? And are they attracting and retaining top talent in their respective fields?
So it's about looking beyond the current products and services and assessing a company's ability to generate new ideas, to adapt to those changing market conditions, and create those products and services of the future. What other pitfalls should we be aware of?
So dependency on a single customer supplier or government contract can be a significant risk.
Yeah.
The
book mentions the food and beverage industry as an example.
Okay.
Even though it seems like a safe bet, right?
Yeah.
It can be impacted by the growing influence of large grocery retailers,
Right.
these retailers have just tremendous bargaining power.
Yeah, they do.
Which can squeeze the profit margins of even the most established food and beverage companies.
Yeah, that's right.
So it's a reminder that even seemingly stable industries can be disrupted by shifts in power dynamics.
Exactly. Yeah.
Investors need to consider the concentration of customers or suppliers within a particular industry and assess the potential impact of changes in those relationships.
Yeah, that's right.
So it's about understanding that entire ecosystem in which a company operates. It's not just about the company itself. It's about the relationships and the dependencies that exist within its industry.
Exactly.
What other factors should we be aware of?
So shifting customer preferences can make or break a company.
Right.
Tastes change, trends fade.
Right.
And what was once hot can quickly become not.
Remember those Cabbage Patch Kids dolls everyone had to have in the 1980s?
Oh yeah, of course.
They were everywhere, and then poof, they were gone.
Gone.
Yeah.
It's a classic example of how investing in companies that rely on those fickle consumer trends can be risky.
Yeah. So how can investors distinguish between products with enduring appeal and those that are just riding a wave of temporary hype?
Right.
What are some of the questions we should be asking?
So look for products or services that solve a genuine need or problem.
Do they offer a clear value proposition that resonates with customers?
Right.
Are they supported by strong branding and marketing? And are they likely to be relevant 5 or 10 years from now?
It's about assessing that long-term viability of a product or service.
Right.
Is it a fad that will fade away, or is it something that has staying power?
Right.
Okay, so we've got cyclicality, technological disruption, dependency risk, and shifting customer preferences. Are there any other pitfalls we need to be aware of?
So one of the most dangerous pitfalls, especially in today's market, is short-termism.
Okay.
This is when companies prioritize those quick profits over long-term value creation, often at the expense of future growth.
It's like eating your seed corn.
Exactly.
You might get a quick meal.
You do.
But you're sacrificing your future harvest.
Right. Exactly.
Yeah. The pressure to deliver those quarterly earnings can tempt companies to cut corners, neglect important investments, and make decisions that ultimately, erode their competitive advantage.
So how can investors identify those companies that are focused on that long-term value creation rather than those short-term profits?
Yeah.
What should we be looking for?
So look for companies with a clear long-term vision and a management team that is truly committed to investing in the future.
Right.
Do they have a history of making investments that may not pay off immediately, but position them for long-term growth? No. Are they willing to sacrifice those short-term profits to build a sustainable competitive advantage?
It's about assessing a company's strategic direction.
Exactly.
Are they playing the short game or the long game? Are they focused on maximizing that shareholder value over the long term?
Yeah.
Or are they just trying to make a quick buck?
Right, exactly.
And it's not always easy to discern.
No, it's not.
Right. It requires careful analysis of a company's financial statements.
Yeah.
Their management teams, track record, and their overall strategic direction.
Right.
Okay, so we've explored these potential pitfalls.
Yeah.
Now how do we take all of this information and actually implement a quality investing strategy?
Okay, so first and foremost, focus on the fundamentals.
Okay.
Dig deep. Understand the business.
Yeah.
Its industry, its management team, its competitive advantages, and its potential risks.
Yeah.
Don't be swayed by market hype or short-term fluctuations.
It's about doing your homework. Right. It's about taking the time to really understand a company before investing your hard-earned money.
Exactly. And remember, quality investing is a marathon, not a sprint.
Right.
Be patient.
Yeah.
Let compounding work its magic.
Let it work its magic, yeah.
And don't be afraid to miss out on those short-term rallies.
So no panic selling.
Yeah.
No chasing the latest hot stock tip.
Exactly. Yeah.
It's about having that long-term perspective and sticking to your investment strategy.
Absolutely.
Yeah, that makes sense.
And remember, not all cheap companies are good investments. Sometimes the low prices are a warning sign, not an opportunity.
Oh, okay.
Be wary of of value traps companies that might look cheap on the surface, but have underlying problems that are likely to persist.
So how can we avoid falling into those value traps?
Right.
What are some of the red flags we should be looking for?
So look for companies with declining revenues, shrinking profit margins, high debt levels, or history of poor management decisions.
Okay.
These are often signs of deeper problems that may not be, easily resolved.
It's about looking beyond the price tag.
Yeah.
And understanding that underlying health of the business.
Exactly.
What other advice do you have for implementing a quality investing strategy?
Be aware of your own biases.
Right.
We all have them.
We do, yeah.
Whether we, whether we realize it or not.
Yeah.
So don't be afraid to challenge your assumptions, seek out different perspectives, and be open to new information.
It's so easy to get caught up in our own narratives, right? To see what we want to see.
Yeah.
So having that self-awareness and being open to being wrong is so important.
It is.
What else?
Learn from your mistakes. Everyone makes them.
We do, yeah.
It's part of the process,
right?
Yeah. The key is to analyze what went wrong.
Okay.
Identify those lessons learned and use those insights to improve your decision making.
So it's about constantly refining your approach, becoming a better investor over time.
Exactly.
And while we've covered a lot of ground today,
we have.
There's one element we haven't explicitly addressed.
Okay.
Luck.
The wild card.
The wild card, right?
Right, exactly.
What role does luck play in business success?
Yeah.
And how can we distinguish between those companies that are truly skilled versus those that have, simply benefited from being in the right place at the right time?
Right.
It's a question worth pondering.
It is, yeah.
It's a great question to leave our listeners with. I think this deep dive has given us all a fantastic framework for thinking about quality companies and identifying those hidden gems that others might miss.
Yeah.
It's about understanding those drivers of sustainable success and making those informed decisions based on solid research and analysis.
Right.
So to our listeners out there, I encourage you to apply these principles to your own portfolios.
Absolutely.
Think about those companies you admire, the products you love, the brands you trust.
Yeah.
Can you spot those quality characteristics? Can you identify those businesses that are built to last?
Yeah, great questions.
Yeah.
And remember, investing is a journey, not a destination.
That's a point.
There will be ups and downs along the way.
Right.
But by focusing on quality, being patient, and learning from your experiences, you can position yourself for long-term success.
That's what the deep dive is all about.
Yeah.
Helping you become a more informed and confident investor, one deep dive at a time.
Until next time.
Yeah. Thanks for listening, everyone.